you watched the last module on structured notes, or if you've just been around Veripax for a while, you know basically what a structured note is. In this module, I want to show you how we would design a note if our objective was to meet or beat the returns of the stock market. And I'll compare that to a typical mutual fund, which is what most people use to get exposure to stocks. This video is only for informational purposes and nothing should be taken as advice. If we want to invest in stocks, I'm making the assumption that the objective is to meet or beat a chosen benchmark. Now, many people and even advisors might say that the objective is to meet financial goals, but since the random movement of the stock market has no connection with anyone's financial goals, the real objective is to meet a benchmark. We then hope that the historical return of the benchmark continues into the future and is high enough to accomplish our goals. Just want to be clear on what we're really trying to do when we invest in the stock market. The first factor to consider when choosing an investment then is to determine what the benchmark will be, because this is going to be how we measure success. We then need to consider the return characteristics of the investment, the risk or safety margin, if any, and finally our time frame or the duration we want from the investment. Are we going to be day traders? Are we going to constantly look for signals that tell us when to get in and when to get out? Or do we plan to commit to an investment for at least some amount of time? Let's say we want a good growth U.S. large company investment. I'm going to measure success by comparing its return to the NASDAQ 100 index, which is the largest 100 stocks in the broader NASDAQ index. If I just wanted to keep up with a benchmark, I could purchase the Invesco NASDAQ fund, but I want the opportunity to beat the index. So I'm going to choose the Vanguard U.S. Growth Fund, which is rated 4 out of 5 stars by Morningstar, has over $52 billion in it. So it's a pretty popular fund. The return characteristics are pretty straightforward. It picks the best 298 stocks from the Russell 1000 growth universe, and therefore when these stocks on average go up, we get a positive return. When they go down, we get a negative return. As with any mutual fund, the safety margin is 0. As soon as the stocks start to lose money, so do we. And the duration is 1 day. Mutual funds are bought and sold at the end of every trading day, and they need to be able to return any or all investor money within a day. We may plan to hold a fund for a number of years, but we're going to be doing it 1 day at a time. Now, let's look at the performance. The last year kind of sucked, but most people would be happy by making 56% over 2 years and 178% over 5 years, but still it lagged its benchmark. This particular fund has a little more Amazon and Tesla in its top 10 holdings, and the NASDAQ has more Apple and Microsoft. In the last 5 years, it's been pretty hard to beat Apple and Microsoft. So sometimes this fund may beat the NASDAQ, sometimes it may lag, but it can never stray really too far away. So it will always use the same stocks for its top holdings. At Veripax, we have the ability to design and build our own investments. So would I do things any different? Well, yeah. In fact, I had built the investment I'm about to show you about 6 months ago. I'm going to use the same benchmark, and wouldn't it be wonderful if I can consistently get at least as much return and ideally even more return when the NASDAQ goes up? But I don't want to lose more when it goes down. If I wanted to do that, I could just buy a leveraged fund. I want to lose less value when the NASDAQ goes down. Now, I hate to lose money, period, but I can't get a CD that tracks the NASDAQ, so I'll be okay if I lose 15% less than the NASDAQ if it does go down. Unfortunately, I can't just wave a magic wand and get these improvements, so I have to look at this duration thing. Now, I'm not going to look at this investment every day, so having a duration of 1 day or daily liquidity seems a little pointless. How about 1 year? That's better, but no advisor on earth would recommend that you invest in stocks if your time horizon is just a year. So I'm going to give myself 2 years. Now, that doesn't mean I'm locked in for 2 years, but I may get a 2 or 3% penalty if I sell earlier than 2 years. If I sell in a week, it'll be more expensive than if I sell a year and a half from now. Let me show you what the characteristics of an investment like this would look like. Let me first draw in the return of the NASDAQ. So if it goes up, we make money. If it goes down, we lose money. On this custom investment, I was able to get 1.3 times the return of the NASDAQ. So whatever the NASDAQ returns over 2 years, we get 130% of the NASDAQ return. And the safety margin, as said, was 15%. So here's our 15% buffer, and then it starts to lose money after that if the NASDAQ is lower. So essentially we get 85% of the downside of the NASDAQ. The only difference between this investment and the NASDAQ, or a mutual fund that tries to track the NASDAQ, is that we added duration, or at least we added duration that lasts more than 1 day. And really, unless you plan to time the market, which we don't want to do, stock investments probably don't need daily liquidity. So if our objective is to beat the benchmark, with this investment, mission accomplished. Let's go back to that previous slide and fill in some of these performance numbers. If we only held this investment for 1 year, we're not going to get the full benefit of the investment. So if we sold it after 1 year, I'm assuming instead of 130% upside participation, or 1.3 times the return of the NASDAQ, we're only going to get 110% of the upside, and we'd probably have to pay about a 2% penalty for selling it a year early. And that would bring us to a return almost exactly the same as the NASDAQ. If we held this for the full 2 years, we would end up with almost a 95% return. And if we went back 5 years, if I designed the same investment but used 5 years of duration, I could easily get 1.4 times the return of the NASDAQ, or 140%. So in that case, we'd be up to almost a 300% return over that 5 years. Looking at that, it would seem to indicate that more time is better for an investment like this. And actually, I'll show you in a second why I think actually 2 years is a better design. How would we use an investment like this as part of a methodology or strategy? Here's the investment we just created, and let's assume that we invest $100,000. Over the 2-year time frame, the market ends up losing 25%, leaving $75,000 in value if we had invested in the NASDAQ. But we lose 15% less, so our investment expires with $90,000 left, which makes us a little sad, but now we get to design a new investment. Now, if the NASDAQ is down 25%, I'll get much better terms for the same type of investment, meaning more upside participation and probably a deeper safety margin. If we had invested directly in the NASDAQ, the index would need to go up 33.33% to get that $75,000 back up to the original value. For our custom design investments, we start with $90,000, and it would go up twice the rate of the NASDAQ, or 66.67% return, leaving us with $150,000. Again, all we did to get this benefit was move from a 1-day investment duration to a 2-year investment duration. Now, is 200% upside participation in an index realistic? Well, in 2020, this same investment could have been designed with a 300% upside participation. By using customized investments in this way, it creates kind of a self-healing mechanism and actually allows us to look forward to market downturns. The reason I want a shorter duration is that I want the investment to expire in the middle of a downturn to free up the cash. And in fact, a strategy using these investments would involve at least 4 investments, all expiring at different times to make sure we're able to take advantage of market downturns. You might be thinking, wow, this is pretty cool. Why not just build a portfolio with nothing but these investments? I call these buffered index investments, and it's important to remember that they're designed to beat a stock-based benchmark. We've kind of gotten used to the idea that the stock market will always go up and allow us to meet our financial goals, but I'm old enough to remember a 12-year period starting in 2000 where my 401k didn't go anywhere and neither did the market. So as part of a portfolio, I would want other investments that are more targeted for specific financial objectives as opposed to being relative to a benchmark. However, these investments will give you bragging rights for at least a portion of a portfolio. Another problem, if investments of this type were essentially the only egg in the basket, is that a 2-year duration will cause it to respond slower to rapid movements in the market. If the market's going up, this can be a problem for people who like to see how they're doing on a daily basis. And that's just a simple reality of what I've learned from doing this for a long time. Finally, and this is another thing that's a little more psychological than anything, is that we're used to seeing conventional investment names in our portfolios. A portfolio full of custom investments can make a portfolio feel exotic, which some clients and CPAs and definitely other advisors will equate with being risky, despite the downside protection. Okay, that does it for this video. Thanks for listening, and feel free to contact us if you have any questions.